Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 13th, 2019. This video is a second of two that I've done today. I wrapped up just a little while ago, I wrapped up a more extensive video where I cover nearly a dozen different charts on breadth indicators, various breadth indicators, mostly focusing on the long term, the bigger picture, um, market internals, market breadth. It plays a big part into my analysis, and I don't cover those in every update I do. We're usually looking at price levels and trend lines and things, but particularly for the longer term, it doesn't really affect short-term trading that much, but it does help paint the longer-term picture. So if you'd like to see all the additional indicators, I'll go over just one or two in this video. Keep this one short, and I will post that video along with this one on rightsideofthechart.com, and I'll make that public content. I'll start this video out as I did that one, just looking at these short-term charts. This is a 60-minute chart of ES, really. So we're looking at the near-term outlook. In the most recent developments, I've covered this many times. You have all these small divergent highs, divergent lows. But what I'm watching right now are these uptrend lines on both ES and NQ. So this is our uptrend line, our near-term uptrend line, which will trigger a sell signal on ES. And you want to see ES and NQ both break down. I need to modify that trend line. I thought I had done that in the previous video. Let me drag this here, tighten it up just a bit. There we go. So that's it. Let me zoom in a little bit, and you can see what I'm talking about here. Okay, there it is. So we have this uptrend line off the lows on February 8th, forms this rising wedge. And bigger picture is these divergences have been building for some time now. So we have smaller divergences. And remember, each and every one of these divergences, they've played out for trend changes. Small divergences lead to small rallies. Small divergent highs lead to small corrections. They do play out. So this is your short-term swing trading time frame, not at all to be confused with the long-term charts I'm going to go over here in a second. Here's what we're watching again for sell signal. And as I said in that previous video is, let me zoom out a bit, what I'm looking at on targets. Boy, I'm having a hard time today with these charts, trying to get this out before the market closes. We had this sideways trading range here for a couple weeks. We recently broke out of, set up in this another sideways trading range, and so a break of that trend line I think will bring us down at least to the bottom of that range, so you can see the targets there. And then you want to watch that. If that breaks, and I am leaning towards a break of that level, then we'll come down here and most likely visit the bottom of that trading range back from earlier in the early February, late January. Okay, and this is the NQ, the NASDAQ 100 60-minute chart, or NASDAQ 100 futures. Same story. Here's a trend line we're testing as I'm starting the videos. A little dump into the close today. That's a change of character. Lately, we've seen ramps into the close. We'll see how that the day finishes. There's only about 6 minutes left in the trading session, but I highly favor break of these wedges. Clearly, divergence is priced in. And what I mentioned in the other video, remember, the bigger the divergence, the bigger the ensuing correction, whether it's in time or price. So you can see here we had a relatively small divergent high, right there. Clean bearish rising wedge, textbook, and a breakdown. That was certainly a tradable, short. That was probably 2.5%, 3%. You're talking, $1,400 or so on every NQ contract. Depends, of course, how much you trade. Then you had a divergent low right there. Now the trend has been bullish. That doesn't take much, but we had a small bullish divergent low, a little trend line there, and a pop. And that led to this. So it's wash, rinse, repeat. These are the short-term things. Again, not to get confused with the longer-term picture I'm going to go into after this. But that's what we're waiting for, a break of this trend line. You want to see them on both NQ and ES will sharply increase the odds that they will play out. And you can see some potential targets. Same story, really. You have this recent trading range here. Expect to move to the bottom of that. And I would expect a reaction there if and when that gives way. Then move down to here to about the bottom of that previous trading range, around 63.32, and possibly more. We'll just see how things go. Okay, and as far as the breadth indicators, there's many different types out there, and again, the other video over maybe a dozen or so. We'll just start with this one. Some of those that I use, I can go back several market cycles, even into the dot-com bull market in late 90s, early 2000s. So then we capture the bear market. And again, the more more data points you have, whether you're doing technical analysis, whether you're a scientist, whether you're a statistician, the more data points you have, the more accurate or relevant your study might be. So I like to go back as far as possible. What we're looking at here, and you can see this is where stockcharts.com cuts off right here. So I can't go back any farther than that on the percentage of stocks trading above their 200-day moving average. So that's what we're looking at down here. This line represents a percent of stocks trading above their 200-day moving average, and up top we're looking at the S&P 500. Now, logically, the percent of stocks trading under their 200-day or above their 200-day moving average will be bounded by 100% at the top and 0% on the bottom. At no point in time will you see 100% of the stocks trading above their 200-day, nor will you see them all trading under it, but you came damn close back here in 2009. At the lows, it looks like about 2% or so. Only 2% of their stocks were trading above the 200, so that was a pretty bad meltdown. And so one of the things that I noted in the previous video is really the vigor of the rally or the bull market. Like we all know, I don't care how bullish you are, nothing lasts forever. There are some people out there that might mistakenly believe the Fed is omnipotent and can continue to manipulate the markets, keep rates low, lower rates, do whatever they can to stave off all future recessions and bear markets. If you are of that mindset, then good luck to you. But all I can tell you is this market is already the second longest in history. So is the economic expansion, and we are coming up on it being the longest. So I used an analogy in the previous video about baseball games. 90+% of baseball games go 9 innings. Once in a while they go into extra innings. There's no limit. Longest ever played was 25 innings. So we're in the 25th inning if this is a baseball game, undoubtedly. And will we break the record and go to the 26th inning? Very possible. Anything is possible. Records are meant to be broken, but that's where we're at now. So what I noted there is you can see the vigor of the rallies has been diminishing since the market bottomed in 2009 on the initial rally. So you just see lower highs, lower reaction highs all along there in the percentage of stocks trading above their 200-day. So that's something to look at. And so again, we're in an aging bull market, no secret there. And the other things, what stands out on this chart is I've noted the divergences between the S&P 500 and the percent of stocks trading above their 200-day moving average. And it could be wrong. I've gone through this chart, with a fine-tooth comb. But without fail, I believe I've hit every divergent high. And divergence is when you have prices making a higher or equal high with the indicators making lower highs. And there's the closing bell. So what we have here is you can see back in 04, 06, there's your first divergence. And sometimes you get these little corrections, especially during a bear market or a bull market, I'm sorry. This was the divergence leading up to the top back in 07. And although it was a relatively small divergence as far as time goes, because we had much larger divergence here, much larger divergence most recently, what was notable about it is how steep the divergence was. So there are two things when trading, all other things being equal. And what I mean by that is, when I look at different time frames, if I'm studying a chart, watching a bullish or bearish chart pattern on, say, a 15-minute or 60-minute chart, well, the expected move from that, breakout of that chart pattern will be commensurate with the time frame. It's a 60-minute time frame. I'm looking for a move that might last just from anywhere from a few days to maybe a few weeks. When I go out to the daily charts, I'm looking at a move that can last at least couple, 2-3 weeks, maybe several months. And when I go to the weekly charts, I'm looking at a move that will probably last 6 months to a year or more, trend trades. So now, okay, so put all that aside for a second, or park that somewhere else. Now, when I'm looking at a single time frame like this, and this happens to be a daily chart, but it spans many years, typically the smaller the divergence, as you can see, the smaller the expected trend reversal. However, there is another component to that as well. So these divergences right here, leading up to the 07 top, weren't very long in duration. However, the other factor is how steep they were. You can see prices continue to make higher highs as the percentage of stocks trading above their 200-day moving average fell off a cliff. And again, this was the market highs. So that was a glaring red flag back then. And again, it set the stage for what may not look like much here, because this is not log scaling, unfortunately, over here. This is linear scaling, but that's a 55% drop. And you can see going forward, once the bear market was over, we again, divergent high, correction, divergent high, corrections. And some of the other charts that I did in the longer video, I do measure those out so you can get an idea. But most of them were close to 10% and some were closer to 20. All right, so we had, since the bull market began, we had up to this point, the longest divergence we had was that preceding the big move, which some consider a bear market. At the very least, it was a vicious sideways, almost a 2-year. It took the market, actually, I believe it was 2 years or roughly, to get back above where they were. So you had a sideways to down trading period. Many indexes and sectors did enter bear market territory, or at least fell 20% or more. The S&P just barely dodged that bullet. But again, it was preceded, clearly preceded, and there were warning signs with the divergences here. And again, the other videos go across same thing, different indicators, but also in most cases showing you divergences, but then some other buy and sell signals as well, in addition to just looking at divergences in that video. All right, so what we can see is from that point on, the market made another thrust high, another thrust higher, I should say. Here's the good old Trump pump right here. And then we had pretty pronounced divergences. Remember, negative divergence, prices making higher highs. In this case, the indicators failed to make higher highs. So we had equal highs, and that set the grounds for that 20% drop. Or, oh, no, I'm sorry, it wasn't 20%, but it was a pretty vicious 2 back-to-back corrections in early 2018. From there, what happened is it didn't reset. The clock reset right here. By reset, I mean we no longer had divergences. What happened here, since early 2018, is the divergences just continued to build. So we have prices continuing to make higher high in the market, the S&P 500, and you can see the sharp drop-off, just like you had back in 2007. So, and I know that very few, I was alone in calling for the drop the size I was leading up into the fourth quarter of the year. All from the beginning of the year, saw that one coming and said that we would come back and revisit those lows, possibly more before the end of the year, and that's what we got. And again, it was this and many other things similar to this and some other indicators that were pricing that in. The media had no clue what hit them, why these stocks were falling. They were talking about the trade wars. Garbage. Trade wars have been in the works for over a year. Talking about Brexit. God knows how long they've been talking about Brexit. So all these things, they're still out there. What happens is the technicals dictate, these big corrections, and then the media will jump all over and assign any cause for a rally or a correction, because that's what they do. That's all they can do. At least now they are more likely to do segments on technical analysis. I'll just digress. When I remember back in the 80s and early 90s, watching CNBC, and back then all they used to do is occasionally they'd bring on somebody that might talk about technical analysis, and the vast majority of the pundits there, and even those working the newscasters on NBC, they would mock those technical analysis, saying that there was no way to tell where stock prices were going by looking at a chart. But again, this stuff's priced in, and what I'll say, I'll leave it at this. These are long-term charts. These are long-term indicators. Divergences like this are not buy indicator. They're not timing indicators. There are some other breadth indicators I get into the other video that are do a much better job of triggering, buy signals when they're hit. But in this case, remember, divergences can continue to build for a while, but the point I'm trying to impress here is the longer they build and the more steep those divergences, typically the sharper the ensuing trend correction is, or the larger it is. And the other takeaway from this, when I look at this chart, you can see some circles down here that I have. And I did a video just yesterday talking about the retracement. Again, this move looks much bigger than what we have here, but they're comparable. They're comparable in time and the amount of the drop and everything else. And so the $1 million question is this a bear market rally? No different than this one back here. So far, there is very little that I can see in the charts that tell me that there's anything different from this rally right here, this kickback rally to this one. In fact, we've had a lot of long-term indicators trigger recently, sell signals. Again, I've talked about all that quite a bit. I want to just point this out that this move down in this kickback rally so far is comparable in percentage terms as far as the retracements that it's made off the initial leg down. And then what I wanted to add to the video I did yesterday is you can see after that I've heard a lot of buzz about how strong market breadth has been. So this is the real deal rally. The market's going up. No different back then. You can see this move up here. In fact, let's just keep it simple. Take this line, a horizontal line here, and you can see that we fell almost exactly. Here you go. It might have been just a hair high, whatever. You can see close enough. I hit it just. We fell about exactly to where we fell off the initial high right there in the correction in late. That was what, late 2007, just before 2008 down here. There's a year. And so far, let's see, we've run maybe just a hair higher. Grab that, yeah, just a hair higher. So basically, as far as the case that this rally is so strong, market breadth is so good that this is the real deal, I take that with a grain of salt. And I've also said this: what happened in this time around, we had a little meltdown here in late December. Much more so. This was a little bit more controlled descent. And so therefore there was a little bit more controlled recovery. And I did that again in yesterday's video. I told you we're at the same point we were back then right now in retracements as far as how much we've retraced, except back then it took longer to get to that point. And that makes sense because we had a more controlled move down. This was a quick, sharp snap down. As I often talk about, the rubber band was extremely stretched, and the more you stretch that rubber band, the more it's going to snap back when it does finally snap back. So that's what happened. We basically had a V recovery so far, which is usually what you get when you have these meltdown type things. So there it is. And again, so far, what I've seen really pretty much, doesn't perfectly mirror because it never does, but it pretty much mirrors what happened in the early stages of the last bear market. So anything is possible. I'm open to anything the market brings, but right now, like I said, a lot points to the fact that this very well may be a bear market rally, and if so, that should or may shape your longer term view on what you're going to do with your long-term money, 401k funds, that type of things. And then shorter term, it does also, I think, come into play because in trading, when one has to have an opinion. Sometimes I'll hear, some traders say, "Oh, just trade price. Don't have an opinion. Trade what the market does." No. And I'll tell you why. And I say this often. So let's say you have a trend line here, and you're buying pullbacks to the trend line. If you're bullish, then what you want to do is you buy pullbacks to the trend line. They're buying up, and you prepare to do that. You prepare to go long on every pullback. Let's just say there's a lot of reactions here. However, when I see a trend line, a well-defined trend line, and maybe I'm buying pullbacks to that trend line, at some point I will start to see evidence, clear evidence in the chart that tells me, such as these negative divergences, such as divergences in breadth, such as many other things, that tell me that next time that trend line is visited, that trend line will break. So therefore, I now put on a different hat. Instead of preparing to go long and put a stop below, I put on the other hat as a short side trader, and I prepare to short a breakdown or maybe even get in front of it, and which we did here, and identify a 60-minute chart, short a smaller wedge or uptrend line, and then hold on for the bigger move down. So that is the point I'm trying to make here. That is the mindset that I'm taking on the market recently, and we'll see. So proven wrong. Again, long-term funds, that's in cash and bonds. short term. Been taken out on a couple short trades recently, and have a couple that are, as of today. Let's see, we closed about flat, so another flat day. Yesterday we were down flat as well, I believe, or no, that was the day before. Yeah, all right. So let's wrap this one up here. Again, that's the gist of it. And if you want to see some other breadth indicators and how I can use them, or how you could use those, especially longer term, go ahead and check out that other video. It'll be on the homepage. Scroll down, and all the posts are just below the initial image on the site when you come into rightsideofthechart.com. You can also use the short URL RSOTC, right side of the chart.com, and that'll take you there as well. This has been Randy Finney. Hope you enjoyed it.